10-year yield below 4%. Futures are down. 30 minutes till the start of trading. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
OpenAI shatters fundraising records. The ChatGPT maker closed a $110 billion round backed by Amazon, SoftBank, and NVIDIA.
The AI feud between Anthropic and the Pentagon escalates while Jack Dorsey swings the axe at Block.
And MFS's blow-up ripples through the financial sector as more signs of a strain emerge in the credit markets.
Wow, there's a lot today. A lot of stress. Like, it's all the anxious things coming to a head between credit and AI. I have one of the AI stories that we've been following that we're going to talk to Caroline Hyde in just a moment. Shares of Block up 15.8% in the pre-market. They're cutting 4,000 jobs. Jack Dorsey says it's because AI, that it can replace those workers. Now, to be clear, there are a lot of people, analysts included, questioning whether that's actually the case or whether this was a bloated company and they're now using AI as a convenient excuse. But whatever it is, maybe it's a model to follow. Shares are up a lot.
Right. It could be viewed as an up arrow story, right? Even though thousands of people will lose jobs. OpenAI announced, this is another up arrow story, I guess, a strategic partnership with Amazon to bring more models to AWS customers to use more Trainium chips. Amazon will invest $50 billion in OpenAI, which is now valued at $730 billion. Still seems pretty low. Amazon right now down about 0.25% in the pre-market. Danny.
Well, yeah, because if what OpenAI is doing is going to take every single job, is going to ruin software companies, maybe it should be valued at even more. Joining us now is Caroline Hyde, co-host of Bloomberg Tech. I mean, I joke, Caroline, but, you know, it is a pretty punchy number, this new valuation round for them.
It's a punchy number. It's a big number coming from Amazon, who already has a very strong relationship with Anthropic. It's a punchy number coming from NVIDIA, $30 billion from there. SoftBank, Masayoshi Son, once again doubling down on his commitment to OpenAI. And this is at a time where, if you think about it, some of the PR mood music has shifted away from OpenAI and into Anthropic in terms of leading the charge on the plugins and who's really got the best coding tools. But Sam Altman has been focused time and time again on the need for compute. That's what holds back their revenue. That's what holds back the growth, is ultimately the power, the necessity for chips in the data centers. And with Amazon's help, look, that's going to be significant. Amazon had already committed to raising their capital expenditure significantly in the previous earnings. And we are seeing an interview that's being done at the moment with Jassy and Sam Altman, calling about the long runway that Sam Altman now sees from this current fundraise that he provides, and more broadly thinking about going public at a time that is going to be right. But Andrew Jassy really talking about, look, they're still committed to Anthropic, but this is going to be a good news story for OpenAI and their integration.
You know, the Block story I find absolutely fascinating.
Yeah.
And even though those shares are up, what, 16% in the pre-market?
Yeah, exactly.
It's pretty terrifying from the perspective of the Scrutiny research note, right?
True.
It's starting to happen.
It is. And look, Jack Dorsey is a contrarian. Look, he's a guy who makes big, bold bets. Look at the way he brought Bitcoin onto the balance sheet, the way he'd committed to that particular area of crypto rather than perhaps what we've been seeing in terms of stable coins like other payment companies. But the fact that he is saying, I am letting go of these amount of people in one fell swoop. I don't want it to be death by 1,000 cuts. I want it cleanly done, but I want it done in a human way. People have really been calling out the way in which he has been in touch and thought about this going to be a much more human, personal story. It's going to be painful. He has tried to talk about whether this is AI washing. Look, when I put the post on LinkedIn, for every one person who said, here it comes, it's happening, the tidal wave of layoffs is here, 3 people were like, it's just because they were bloated, they'd overhired during COVID. He answered that on X, of course, the Twitter he founded once upon a time, and he was talking about how, look, in 2024 they rectified in many ways for that overhiring. He said, look, at the time he built sort of 2 different companies, Cash App on one side, Square on another. It is a difficultly organized business. He wants to streamline that. But then you also have to think back to what's happened with Klarna, another payments company that said, look, we can do all our customer services with artificial intelligence. And then they had to rehire back a lot of people that they laid off. So there is some cynicism. There's also some very authoritative people out there who I've spoken to who are tracking the AI enablement within these payment companies, saying it's not ready yet. It's going to be a very difficult, sort of longer period of time. But maybe this is if it works, it will be something that other CEOs take into account.
I was going to say, whether or not it's AI washing, you look at the reaction of block shares, and
Yes.
maybe this becomes the playbook because you get rewarded. But I was talking to Matt about this before the show, that Elon Musk said, according to his accounting, he fired 6,000 people at Twitter.
Yeah.
And he said it was because it was bloated and he wanted to take it over. And we didn't bat an eye and say this is some systemic issue because he couldn't use the excuse of AI then. I mean, this has happened in tech before, but it's just because they maybe have something to blame it on that it all of a sudden feels different and systemic.
And look how many job losses we had in January alone. Amazon have sort of PR'd it differently. We heard from Andy Jassy in an investor letter a year ago warning that there will be more jobs done by AI. There will be fewer, particularly in his corporate department. They've let off 30,000 people in recent months. But they've been saying, look, this is also to just rebalance. But really, he could have AI washed a lot more. Think about the huge gargantuan layoffs that we've seen across many a business to start this year. Some have tried to pepper in artificial intelligence. Some have tried to use automation. You'll go to a consultancy company at the moment. They say a lot of this is just legacy tech updates rather than actually the latest, greatest generative AI agent doing your job.
Yeah, and yet Indeed has software job seeking up 11% of job listings out there. So,
And I'll remind you again.
please.
We heard from Workday that Anthropic and AI still use its software. So if they aren't replacing SaaS subscriptions, why would anyone else have to?
Yeah, again, it's the great uncertainty, and we're pricing every outcome right now. Caroline, thank you so much. As always, looking forward to Bloomberg Tech at 11 a.m. New York time. Elsewhere, the other anxiety for your market this morning, the cracks in private credit. An Apollo-run fund cut its dividend and marked down loans as losses pile up. Meanwhile, a private credit fund managed by Future Standard and KKR slashed its payments even deeper, hit by troubled bets. In London, there was another cockroach, if you will. A property lender is collapsing, and big banks like Santander and Barclays could lose millions. Let's get now more with Dana El-Baltaji, Bloomberg's managing editor for credit. Dana, I'm assuming that these BDC markdowns are happening because it's quarterly and they have to mark to market. Are we going to see more pain out there? Is this the tip of the iceberg, or is this no big deal, but everyone's paying more attention to it just because of the scrutiny around private credit?
I really like the way that you described what's happening with block and AI. There is a great uncertainty here. And the issue is that because you have these marks, every quarter, we have to guess where the next cockroach is. And so every now and then we get a glimpse, we don't like what we see, and the market reacts. It just so happens that it's all happening at a time where software is a real issue. People are wondering what else AI is going to affect. And of course, I mean, a lot of these private credit firms are highly exposed to all of these industries. So absolutely, we don't know exactly where the pain points are, but every time something does happen, people are worried that there are a lot more out there.
And something did happen today. I woke up to see that MFS was a problem on your side of the Atlantic and is causing ripples across global Wall Street. What's the story there?
So the issue here is there is a company called MFS. It was a mortgage servicer, really. But in any case, it got a lot of funding from banks, from private credit firms, and it has gone bust. Now, the issue here is not just the fact that it has gone bust, but the fact is that the assets that are backing those loans seem to have been pledged once, twice, 3 times. This is still playing out in the courts, so we don't know exactly what happened. But the issue here is that asset-backed lending was supposed to be the darling for direct lenders. And now we're seeing these issues with these assets.
All right, Dana, great to get your take on credit. You know the market so well. Dana El-Baltaji there out of Bloomberg News in London. We'll have more on the private credit markets from the Bloomberg Invest Conference. Danny and I will both be there for open interest on Tuesday and Wednesday next week. You'll hear from Apollo's Mark Rowan, Mike Arrighetti of Ares, Don Fitzpatrick of Soros Funds, as well as Bruce Richards from Marathon and many, many more. Let's get, though, to the big M&A story that maybe we finally see an end to. Paramount is poised to buy Warner Brothers after its latest offer went unmatched by Netflix. If it closes, Bloomberg Intelligence says Paramount's EBITDA could quadruple. That's earnings before interest, taxes, depreciation, and amortization. Bloomberg Intelligence media analyst Geetha Ranganathan joins us now. So, Geetha, I guess this is a relief for the Ellison clan. You know, Paul Sweeney has been saying for months it's a must-have for Paramount, whereas it was a nice to get for Netflix. Why did they give up so easily, Netflix, though? They have so much more money.
They do. They have a lot of financial firepower, but this is exactly what we were constantly saying. I mean, Netflix has always been so disciplined in terms of capital allocation. And this is your classic case, Matt, where losing, the war might actually be winning the battle. I mean, this is a great outcome for Netflix because it doesn't muddy the narrative anymore. You know, the deal was introducing a lot of regulatory risk, a lot of execution, integration risk. All that goes away. Plus, they get $2.8 billion in termination fees as an added bonus. So I think all around, it's a win-win for everybody here.
I mean, but presumably, Geetha, Netflix could have upped their offer with the giant cash pile they have. What would be your understanding in what the line is between offering more and getting this asset, which they talked ad nauseum about, how it was important to them, and they did need this, they needed the IP, versus just saying, well, take that $2.8 billion and walk away?
Yeah, I mean, this was the constant question, Danny. I mean, did they really need this all that badly? They did see an opportunity when, the Warner Brothers Discovery assets were up for sale. Yes, they looked through it. They made the offer. But at the end of the day, I think what happened was, we obviously had that meeting yesterday between Ted Sarandos and the White House government officials. We really don't know how that went. But right after Warner Brothers Discovery deemed that the Paramount Skydance was a superior offer, and you kind of had that White House meeting where they probably got some signals that things weren't really going to go their way. Netflix obviously backed out. I think it's good because, again, it removes a lot of the risk and basically goes back to their story. I mean, their whole MO has been build versus buy. They've managed to do that. They've managed to disrupt an entire media ecosystem. They should be able to absolutely maintain their streaming dominance as they focus on their core drivers. I mean, we have double-digit revenue growth. You have 20% EPS growth through 2030. You have operating margin expansion of something like 300 to 400 basis points. And they're throwing out something like about $10 to $15 billion every year in free cash flow. So all around an organic growth story that is pretty strong, that was probably going to get diluted a little bit with this M&A.
What about Paramount Skydance? I mean, I'm sure that the industry, or possibly the industry, is happy about this because David Ellison and his sister really seem to want to make good movies. And Larry Ellison obviously has a ton of money. He's, I think, 6th on the Bloomberg rich list with over $200 billion as measured by us. But how much do they have to make now to cover their nut? Because they're taking a lot of debt here.
They're taking a tremendous amount of debt, Matt. I mean, if you look at the pro forma leverage of this company, it's going to be 7 times. Dangerous levels of leverage, we would think. But yeah, I think it is good overall for the industry. I mean, from Paramount's standpoint, really, they really didn't have much of a chance as a standalone entity. I mean, organic growth, it was going to be really, really tough. They're a subscale streamer. Very heavy exposure to a declining TV ecosystem. This was absolutely, as you characterized it correctly, this was a must-have for Paramount. And we'll have to see how things work out. I mean, obviously, you still have execution integration risks, but they have pointed to this humongous synergy number of $6 billion. So we'll have to see if they're actually able to deliver on that.
Geetha, thank you so much for the latest update this morning. Geetha Ranganathan of Bloomberg Intelligence. Let's get a quick check on futures this morning. A really bad day for Russell 2000 futures, but a weird dynamic because yields are lower, below 4% for the 10-year yield, but PPI came in hotter. So I guess we're losing jobs and dealing with sticky inflation. So try to put your head around that one. NASDAQ 100 futures down about 1%, S&P down 0.9. Coming up, we talk about the Paramount deal with one of its proxy advisors and much more. As the proxy season heats up, we talk with Bruce Goldfarb. That's coming up next, just after this break.
Let's get now to high interest. Look at what's making headlines around the world. The U.S. and Iran agreed to resume nuclear talks next week with Technical teams meeting in Vienna as President Trump ramps up military forces in the Middle East. Tehran is refusing to move its enriched uranium abroad, rejecting a central U.S. demand. Washington has voiced frustration over the slow progress, and you can see Brent crude continues to move higher. Bill Clinton will be the first former U.S. president compelled to testify before Congress, facing questions about his past ties to Jeffrey Epstein. Former U.S. Secretary of State and his wife, Hillary Clinton, was deposed a day earlier. She said she never met Epstein and insisted her husband knew nothing of his crimes. Lawmakers called the subpoena unprecedented as Democrats push for President Trump to testify as well. Wells Fargo is expanding its lending business to work more closely with smaller private equity firms. The bank has launched a new team to provide loans and connect those firms with its growing investment banking division. It's part of a broader push to compete more directly in the private credit market. Danny?
And Bank of America did that recently as well, we should note. Elsewhere, Paramount shares are climbing as it plans to spend $111 billion for Warner Brothers. Let's bring in Okapi partner CEO Bruce Goldfarb. His firm is a proxy advisor for Paramount, so would be helping with understanding what the shareholders of Warner Brothers might want. Bruce, probably one of the busiest men in America at this moment. How are you thinking about this? What's next for shareholders?
Well, there's a lot for shareholders to still do here. There's still going to be a vote, but more important, right now, think about what a great day it is for shareholders relative to the sort of battle that was going on. There's more to come. Over the past few days, we've had shareholders calling and saying, what is going to happen next? And that's a lot of what we do. We communicate with shareholders of all sorts. We had a lot of retail shareholders calling, as you may appreciate. Warner has a lot of retail shareholders, including former AT&T shareholders who now own Warner. And then there are institutions and ARBs and hedge funds. So there's a lot more to come, but it's a win for all. If I think differently, and if I give Warner some credit for a great movie this year, for us, it's been one battle after another.
What an incredible film.
It is really good.
Absolutely. And we have been busy with not just this situation, but so many others, whether it's on the activist front, representing some companies who are going into proxy season, and we've had M&A, and there's a lot of other contested situations that have happened, friendly deals where investors want to check on the price that's being offered. They want to talk about process. They want to make sure that they're getting value like they're going to be getting here at Warner.
First of all, I went to see that film twice in the theater. And I wonder if Paramount hasn't, much like the assassin in one battle after another, bitten off a little bit more than it can chew, because they're taking on a lot of debt to make this happen. Now, I know that they need to do that. All the media analysts we've spoken to have said this has to be part of the plan. They have to have Warner Brothers to succeed, and that looks like they will. But how much money are they going to have to make to cover it?
That's not for me to talk about today, Matt. There's a lot to come out, and I know we are working with some of the smartest people in the business.
What about the Netflix side of things? Because this is a company whose shares had been hit really hard on this. Again, putting on not necessarily your Paramount advisor hat, but your proxy advisory hat. Do you think this would have been a company ripe for an activist to come in had they actually gone forward with this deal?
Well, appreciate that Netflix is a large company. Their shareholders do care about the situation. And if you look at shareholders, largest shareholders of Netflix, you look at largest shareholders of Warner, Paramount, there's a lot of cross ownership. And each of those companies would have heard from their shareholders. That's what happens in every situation. The shareholders have opinions. Part of our job is to help our clients understand who those shareholders are, how they think and behave about situations, put our clients in communication with the shareholders so that they can make the right decisions, so that they can execute on the deals that they want to do. And that's certainly what's going to happen here.
By the way, have you noticed that Danny Berger has a new deals show? Every
Thank you,
Wednesday at noon,
Thank
an
you.
hour-long show focused solely on M&A, because it's such a busy time right now.
I know that, and I've been watching. It's great.
What do you think? Obviously, it's the start of proxy season, so we're starting to get these various things coming in. I know you work with Elliott as well. They're looking at Norwegian cruises. What do you think the play is here? Because this is a firm that doesn't necessarily like to go all the way down the road of the proxy fight. What do you think the ultimate end game is for this?
Well, I don't know that I would characterize any activist as a firm that's unwilling to go and have a proxy fight.
Right.
The reality is that when an investor like Elliott, who is very smart, very sophisticated, wants to look at a situation, they've done their homework, they have a thesis, they're presenting that thesis to management, to other participants, to shareholders, and if they need to have a proxy fight, they have a pretty good sense that they have a possibility of winning, a probability. I mean, we help them with that, and we help them understand whether or not they're going to win. We've worked with a lot of investors over the years and companies where we lay out the odds and say, you're not going to win or you're going to win. You have to really know what's going to happen with the different shareholders. But ultimately, it is about value creation. And whether we're talking about cruise lines, shipping container companies, dry bulk companies, whether we're talking about entertainment and media, oil and gas, there are so many sectors where we have this uncertainty in the market, and companies need to articulate their plans to their shareholders, or they're going to have investors speaking up saying, you need to do it a little better.
So what have you heard? What has been the reaction from shareholders? Let's just take Elliott Norwegian as an example. Have they been pretty welcoming that, yes, this is a company that needs an injection of life?
You find almost every time that Elliott comes into a situation, the shares go up. So the reaction is almost immediate. And that kind of reaction is what helps a company understand whether or not there's something to be done here. Now, we work with a lot of companies, too. And we help those companies understand and appreciate whether what an investor is saying is worth pursuing more. And frequently we find that the good ideas come from management, boards heard them, but also these shareholders. And other shareholders will then amplify what an Elliott is saying. And that's where you end up with potentially the value created from investors speaking up.
Bruce, you have so much experience in this arena, and from Cravath to Columbia to Okapi now. I can make a comment or try and compare and contrast the regulatory environment under President Trump and President Biden, but I don't know it as well as you do. Is it really as stark as I would have thought?
There's a lot of differences in how all of the participants are looking at transactions now. We worked on a number of situations during the Biden administration that, frankly, were hard to get done or didn't get done. We worked for Spirit Airlines. And so you talk about a situation that maybe should have been done with Frontier.
It feels like nothing got done under the Biden administration, and everything can get done now. Is that...
I mean, when we're talking about things like Stripe buying PayPal, like two direct competitors, it feels like deals are being dreamed of that never would have happened before.
And probably to the benefit of investors and to the benefit of the markets in general. That's the exciting part of what we do. We do talk about how we communicate these deals to investors who have the same kind of questions that you do, Matt. Is this something that can achieve regulatory approval? When is it going to happen? Should I be buying now? We don't make investment advice. We don't give investment advice to clients, but we help them understand the timing and what could happen next.
All right, very cool. Great having you on. I hope we can get you back, or maybe you'll go on Danny's Deal Show.
We'll take both. We'll happily take both.
Danny's Deal Show, Wednesday at noon. Is a do not miss if you care about this environment. Okapi Partners CEO there talking to us, Bruce Goldfarb, about not just Netflix and Paramount, but about M&A in general. Less than 4 minutes to the opening bell. We begin the trading day with Anastasia Amoroso. Stay with us for that because futures are down hard. This is Open Interest. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. Take a look at futures because in a month that's already looking like a loss, they're down 1% on the S&P right now. NASDAQ futures down even more, and the small caps down 1.5%, even as the 10-year yield comes in below 4%. And Danny tells me this because PPI was just too high. You see here, well, that's Jim Neeson. He's the managing director and founding partner at the Connor Group. Great guy to ring the bell today because they're holding an IPO summit, and that's what the NYSE probably, definitely, absolutely wants more of. They're getting one down at the NASDAQ. Generate Biomedicines ringing the opening bell, raising $400 million in an IPO, so that will start trading today. Danny, there's a lot going on in these markets.
Yeah, and a lot going on that we're freaking out about, that we're like, there's, fires to be put out. I mean, whether or not
this story, by the way, that you're about to show us is the perfect end to a week that started with Scrutiny research, right?
That is actually so well put. Of course, this is the logical conclusion that you get a warning that maybe the white-collar labor market is going to be completely different, and then you have a company saying, yes, that is what's happening, and that's what we're doing. Block cutting 4,000 jobs. Jack Dorsey saying that AI can replace those workers. But Matt, we talked about this earlier in the hour. There have been many who have said this was a bloated company and they would have needed to make those layoffs anyway, and maybe AI is a convenient excuse. Whatever it is, shares are higher by 17.3%. So, or now 18%. So maybe this is the model to follow. Your shareholders will reward you if you cut a whole lot of employees and say it's because of AI.
Right. I mean, he also raised his profit forecast at Block. So that doesn't hurt. OpenAI announced a strategic partnership with Amazon to bring more models to AWS customers. Amazon will invest $50 billion in OpenAI, which is now valued at $730. I think in total they got $110 billion of investment, and they're going to buy some Trainium chips, which is the part that I find interesting as well in the battle to see if anybody can catch up with NVIDIA. Let's bring in Anastasia Amoroso, Partners Group Chief Investment Strategist of Private Wealth there at Partners. Anastasia, great to have you here.
Good morning. Good to see you, Matt.
You know, last time we had you on, we probably asked you if there's a bubble in AI, and that is no longer
I said no.
a discussion, right? Now the concern is AI going to, well, kill us all, right? I mean, Anthropic has said we're not going to let AI control weaponry, and it seems like the Department of Defense wants that to be the case. But what do you think about all of this investment? Are we just going to see it continue to climb higher and higher and higher?
I do. I think the Amazon and OpenAI news is really telling, and that is you really see companies, the Gen AI companies like Anthropic, like OpenAI, really gain traction, and not only in terms of adoption, but also in terms of monetization. And for example, if you tally up the revenues for the top three leading AI companies, they were 54 billion or so this year, or projected to be this year. They're projected to grow to 307 billion by 2030. So that's the revenue growth trajectory that allows the likes of OpenAI to raise that. And the other thing, Matt, I will say, I will bring it back to our business, and I wanted to share an announcement with you today that we've announced that we've sold one of our data center portfolio companies at North to Equinix, which is one of the largest digital infrastructure companies, and also Canada Pension Plan. And the reason I highlight that is because we've been long convinced in the data center opportunity set, and the fact that OpenAI sees revenues, is able to raise funds, they're going to route those funds back into data center capacity and semiconductors.
Well, if you're convinced, why sell?
Well,
I mean, selling is like, okay, we're at the top here.
Presumably you're buying some stuff, too.
Well, this is also not our only data center holding. Look, we've been data center investors since 2020. That's when we first, unveiled the data center theme, and we've invested about $5 billion in data centers in Europe, in North America, as well as Asia. So we certainly do still have exposure. But Matt, to your point, why sell is because we've really worked alongside at North to scale the company, to really scale the data center platform from what was 2 sites at the onset to now 8 sites focused on the Nordics region. And we've grown the EBITDA about 14-fold. And as a result, we're able to help the company, I would say, to help ensure compute is more available in the world and also help our clients achieve pretty significant returns, over 30% compounded annual growth rate, or 2.5 times in terms of capital return on capital invested. So that's the reason. And we also believe that depending on where the company is in its life cycle, we were the right owners for that company when it was small, when we were building that up to a mid-sized scale. Going forward, Equinix and Canada Pension Plan, we believe, are the right owners. However, we do believe very much in atNorth as well as data centers. So we are reinvesting a share there as well.
And again, as you mentioned, Partners Group has been doing infrastructure for some time now. It does feel like for the world, for private capital, for public equities too, it feels like a shift has happened. We're out of COVID. We love these software companies that are just a couple of dudes coding in a basement because they're super asset light and margins are fantastic. Now it feels like it's shifted. And correct me if I'm wrong here, that asset heavy infrastructure, real world, this is where it's better because it's protected from AI.
That's right. That's exactly what the market is telling you this year. I mean, it's stunning. You look at the S&P and it's barely flat or maybe even down a little bit for the year, depending on the day that you look at. If you look at data centers, for example, they're actually up about 20%. If you look at defense companies, they're up, and semiconductors are faring better than software. I think it's spot on. And if I look at sort of how CapEx is shifting, has shifted in the last few quarters, the software CapEx has been slower versus the hardware CapEx has certainly been picking up. And let's just say something else here. It's not only data center CapEx that's driving that. This year we have seen sort of this inflection point, and whether it's utilities, whether it's capital goods, whether it's commodity producers, they too are participating in this hard asset CapEx. The last point, Danny, I will say, look, if you think about software, parts of software, you can disrupt that with a stroke of perhaps Anthropic code. But if you think about a piece of machinery, a piece of equipment, you can't make that obsolete overnight.
It seems like, yesterday we had weekly payrolls, and I didn't even notice. Today,
nobody noticed economic data this week.
Danny had to point out PPI to me as the reason for the small caps dropping. Like, economic data, Mike McKee is not sitting here.
Or even earnings, to be fair, too. I feel like we're also kind of overlooking really good earnings, too.
Good point.
Doesn't seem to be what's driving the market.
Is it distracting us too much?
Well, I actually wrote this in my notes that I can't remember a time when we paid so little attention to economic data, but let's do actually pay some attention to that. And I think the reason for that is because the economy has been quite strong. Whether you look at the consumer side, which is being boosted by the refunds as we speak, whether you look at, also the consumer side being boosted by the rate declines as well. But I'm really encouraged once again about the rebound that we're seeing in corporate CapEx. And, what was sort of a single engine economy may actually have multiple engines to it. It's the tailwinds of tax policy. It's the tailwinds of productivity, which we talked about from AI. So, so I think.
But what's your take, Anastasia, on the labor market? Because, Danny mentioned software hiring
is up 11% year-over-year on Indeed. Yeah.
On the same day that Jack Dorsey is like everybody else, we're getting ahead of this. Everybody else is going to have to fire half their staff too.
Yeah.
I was reading Data Trek. Nick Colas pointed out that people are still demanding work from home, and a sign that the labor still has kind of the upper hand here. Which is it?
Yeah, I mean, for now, but I would say the labor market is shifting as we speak. If you look at the layoffs last year, about 5 or 6% of them were attributed to artificial intelligence. But there's this big category of economic conditions. Who knows what's all in there? I think as we move forward, you'll see that share of layoffs due to AI rise. And if you look at it on a very granular level, if you look at the labor force and who has the greatest automation potential, about 1% of the labor force today has 100% automation potential. Guess what happened with that category of jobs? They have started to roll over. Now, a quarter of the labor force has a 90% automation potential, and we've seen employment in that sector stagnate as well. So I do think that whether it's the Klarna headlines we got a little while ago, whether it's Block, I do think more of those announcements are to come. So I don't buy into the Citrini dystopian scenario that was described on Monday, but I do think there are cautionary notes in it that we should be watching.
Anastasia, this has been so fantastic. Thank you so much for joining us. These are such complicated topics, and you speak on them so well. Anastasia Amoroso. Let's get a check on your equity market right now. It's not looking like a great day. We are down nearly 1%. 327 stocks are down, only one unched today. 177 are higher. As to the higher stocks, the one that's leading the pack right now is Netflix. They're going to get a nice $2.8 billion breakup fee. You could probably film a couple movies. Oil and energy, that's having a good day too. The U.S. and Iran talks continue next week as the force buildup continues. Dell, those earnings good because of AI server demand. And then Block, this is the story we've been talking about. If I need to remind you, firing 40% of the workforce, they say, because of AI. Nvidia not having a great day. Neither is Microsoft or Apple or Broadcom. These are giant stocks, and that's why the index is down. Nvidia dragging the index down by 9 points so far this morning. Let's look at the sectors. It's going to look much the same in that infotech is down. The credit card company is also having another bad day. Consumer discretion, that index has been beat up this month. And then you get the safety plays at the top. You get consumer staples, energy, that's surrounding Iran. And Matt, I got to say, I know we're going to talk about this later, especially with David Gura on their new weekend show. But with all the things that are playing on in the background that we're ignoring, the economy, the earnings, I wonder if we have to add Iran to there. Are we paying enough attention to what could be some serious escalation? Well, and I mean, who better to talk about that with than Christina Ruffini, who is going to co-anchor that show with David Gura. I'm very much looking forward. This weekend, actually, you know, MotoGP starts the 2026 season this weekend. Wow. So it's already been on my calendar since last November, and the Bloomberg weekend show. You're just going to be sat on the couch, glued to the TV all weekend. Absolutely. Love it. Positively. Coming up, open to talks. The Pentagon responds to Anthropic after rejecting its offer ahead of today's deadline. We'll discuss something that could be even scarier than the Scrutiny research report next. This is Bloomberg Open Interest. Let's get you some top calls. The analyst action, the sell side that we are following this morning. First up, TD Cowen. They upgrade Southwest Airlines, saying that airline demand looks stronger this year. The firm also says changes to Southwest loyalty program will help to boost earnings, but the real test is whether customers will keep their credit cards over time. Shares down 1.7%. Next up, Cars.com. That gets downgraded at JP Morgan. The firm says that it's hard to see when the company will start growing faster. The analyst says that competition is heating up, especially from AI tools and bigger companies offering more complete services to car dealers. Those shares down 6%. And finally, Morgan Stanley cutting Duolingo, my beloved owl, saying it was wrong to expect that the company could grow users and make more money at the same time. The language learning software company reported an outlook below expectations. Evercore ISI, JP Morgan, Citi downgrading the stock, shares down 20.5%. And unrelated, I currently have a 50-day streak on Duolingo. Matt. Are you actually learning anything, though? What language are you trying to learn? I'm doing Spanish. I have high school, only present tense level Spanish, so I'm hoping at least it helps me remember, I don't know, vocab. Jury's out whether it's actually helping me or not. All right, maybe I'll give it a shot. My wife is from Spain, and, you know, we've been together for 13 years. I feel like it's embarrassing that you go to Duolingo to learn Spanish and not your own wife. I mean, she thinks it's embarrassing that I don't speak Spanish. I got it. It's true. The Pentagon is open to more talks with Anthropic ahead of today's deadline to ease restrictions. Bloomberg spoke with Emil Michael, U.S. Undersecretary of Defense for Research and Engineering, about the negotiations. I offered more talks. So long as they're in good faith, we're always open to talks, and we set a deadline, and we met the deadline, and up until that deadline, I'm open to more talks, and I told them so. Joining us now is Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. And Mandeep, you know, I read the Anthropic statement yesterday, and it seems like the two things Anthropic isn't willing to do is let the government use AI to do surveillance on its own people, on us, and let the government use AI to autonomously control weaponry. Surely the government doesn't want to do either one of those things, right? That would be insane.
I would agree with that. And look, I think with Anthropic, because they've been so focused on guardrails from the get-go, for the CEO, this is probably one of his big things that he has highlighted as a differentiator. And he doesn't want to completely, give up on that guardrails aspect, even though, the entity here that is looking to use that is the U.S. government, and their point is around national security. So from that perspective, I mean, I go back in time, what the other software companies have done. And, you always have to have the government on your side, and especially when it comes to national security. So it's going to be hard for someone like Anthropic to maintain their stand, at least as is they have right now.
I mean, have you seen Terminator? We've all seen Terminator, right?
Yeah.
That's the whole premise, that AI controls weaponry, and is it not? Am I?
No, it is. It is. But also, Mandeep, doesn't Anthropic, okay, two thoughts on this. One, doesn't this sort of cement how great of a foundational model Anthropic is if the Pentagon has to keep being like, okay, we're open to talks, we'll work with you. It seems like they need Anthropic. And number two, given the doomsday scenario Matt is laying out, don't you think this would be bad for their image if they caved to the Pentagon?
Not really. I mean, you have to think in terms of geopolitical context and, the competition that I guess we have with China. And then again, the national security aspect of it is huge. So, Anthropic is in a dominant position. Like you said, they are among the 3 leading foundational model players right now. And the government is keen to use their product for intelligence. So, at this point, you have to think about who your end user is. If it was any enterprise use case, I totally understand. But if it's the government and they're talking about it from a defense standpoint, again, it's hard to argue, why you would not relent in that case. And I mean, clearly, Dario has his points around that. And I'm guessing this will have some sort of a negotiation phase, and obviously they will probably, come to some sort of agreement.
Yeah, I thought it was encouraging that Emil Michael said we're open to continue talks here.
Yes, and again, maybe that just shows how dominant Anthropic is. Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. Coming up, how ETFs can provide an escape hatch for the stress in private credit. By the way, the latest headline, MFS creditors alleging that there was £930 million in a shortfall from double pledges. The fraud saga continues. That's next. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Happy Friday. Or not, if you're long stocks right now. The S&P 500 is down 0.9%. The NASDAQ down 0.75%. So some big drops here across the board. Wow, the small cap's off 2% as PPI comes in hotter than expected. Also, NVIDIA is down right now, so 2.5% drop in that big behemoth doesn't help at all. Block, which is not a big behemoth, is up a lot, 14, almost 15% right now after Jack Dorsey said he's going to fire half the staff, replace them with AI, and that means they're going to make more money this year. It's what shareholders like to hear. Netflix right now up almost 10%, so gaining a tenth after they said, you know what, we're out. We don't need Warner Brothers Discovery. We'll just take a $2.8 billion breakup fee and go our merry way. Paramount is up because they are going to get it. Looks like Warner Brothers Discovery, so gain of 4% there. And then, the private credit story that Danny has been covering so well continues to see fallout with a lot of marks disappointing the market. Apollo right now down 7%. Blue Owl down another 5%, Danny.
And just adding to the stress this morning, the latest breaking news that MFS, that fund, or rather the creditor that was in the UK. That seems to be another cockroach. Apparently 930 million pounds, or about $1.2 billion worth of double pledges. So concerns about fraud. Now, this is not a fraud story at all. It's very different. But Blue Owl, as you were pointing out, Matt, continues to fall. Its move to restrict withdrawals exposes enduring tension between liquidity expectations and illiquid assets. Investors lost control of redemption timing, but the ETF wrapper offers an escape hatch, according to Bloomberg Intelligence. Joining us now is James Seyffert of Bloomberg Intelligence. So, James, there's been this real big anxiety around BDCs and the liquidity profile of them. What do you and the team mean by the ETFs offering an escape hatch?
Yeah, so there's a huge push right now to put private assets into an ETF wrapper. There's people trying to do it with private equity. There's a huge push to do it with private credit, which is very relevant to what you're just talking about with Blue Owl. And you're probably going to think that I'm going to sit here and say it should just all be in an ETF wrapper, but that's really not the case. What we're saying is there's trade-offs to however you do this. If you're going to do it in an interval fund, like that Blue Owl fund you were just talking about, you're going to be locked up potentially for much longer than you might want to be. But that's kind of what you're doing when you're investing in a liquid asset. If you're buying a private credit fund or a private equity fund, you name it, like in some cases, you're locked up for 10 years no matter what. These assets are illiquid. But there are examples of ETFs that go completely illiquid and you can still trade them. The question is, would you rather be able to get out at a potentially massive haircut, a huge discount, or would you rather be forced to be stuck in there? So these are all trade-offs that you make, but the ETF does have a lot of benefits. And there's a few examples we've looked at in history that show us those benefits.
James, unfortunately, we're running up against the clock, but I'm looking forward to more coverage of this on ETF IQ Monday. James Seyffert there of Bloomberg Intelligence makes up like our ETF triumvirate on the BI side, right? We got Eric Balchunas, Athanasia Sarafigas, and James covering it there. And then, of course, on Bloomberg TV, ETF IQ, you've got Balchunas joining Katie Greifeld and Scarlet Fu. That is a must-watch hour of television now, a full hour of television.
Yes.
Every Monday if you're into ETFs, as pretty much everyone is. It's like the most important wrapper in the investment world.
It's a great show, and we have another hour coming up for you here on Open Interest. The CEO of Monroe Capital is going to talk about private credit fears. We're also going to talk with the head of Algorhythm. Remember that little karaoke company that pivoted to AI and sent an entire trucking sector plunging? We'll also speak with Gary Atkinson, the CEO of Algorhythm. All of that in your hour 2 of Open Interest.
We are 30 minutes into this trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. With the move this morning, I've just confirmed it by looking at Matt's favorite function, the comp screen. The S&P is now down for the year, 0.01%.
I will say that historically, at least over the last 29 years, we break even at this point, right? Because over the last 29 years, the average gain for January is 0.3%, and the average loss for February is 0.3%.
Okay, so we're in the historical norms.
So we're right there.
More painful
and
for some reason.
It hasn't been a bad couple of years.
Okay.
Coming up, the S&P is set for, as I just said, a monthly loss after a volatile February fueled by AI bubble fears and then disruption concerns.
Among those disruption concerns, an AI feud between Anthropic and the Pentagon escalates while Jack Dorsey swings the axe at Block.
I think actually surveillance de-escalated that feud a little bit this morning.
Yeah, I'd say they did.
Because Emil Michael was like, yeah, we'll ask him to talk again. MFS's blow up in London ripples across the globe as more signs of strain emerge in the credit market, some comparing it to the tricolor or First Brands cockroaches. And so we also see at the same time marks to market that are bringing down private credit operators.
Correct. The BDCs are marking things down. MFS in the UK double pledged over $1 billion worth of assets. There's a lot of sentiment shifts happening, and one of them is also in AI. Anastasia Amoroso, Partners Group, is following CapEx allocation.
And if I look at sort of how CapEx is shifting, has shifted in the last few quarters, the software CapEx has been slower versus the hardware CapEx has certainly been picking up. And let's just say something else here. It's not only data center CapEx that's, driving that. This year we have seen sort of this inflection point, and whether it's utilities, whether it's capital goods, whether it's commodity producers, they too are participating in this hard asset CapEx.
Let's bring in Joyce Huang, Senior Client Portfolio Manager at American Century Investments. So, I mean, what's your take on this AI month? It's been insane, right? Worries about a bubble turned into worries about a dystopian future with, 10% fewer or 10% unemployment, I should say, after the Scrutiny research note. Now we hear that Anthropic says they're not going to let AI control weaponry, and the Pentagon seems to actually want that. Where do you fall as an investor?
Yeah, I mean, speaking of equity markets being down, as fixed income investors, we're up, and it's actually been a really good year for fixed income. We've seen the 10-year come down. We've seen rates rally in response to these fears in the equity market. So as active investors, we actually welcome some of this volatility. Going into this year, we thought spreads were really tight, and now that they've widened out a little bit, we do think there's more opportunities. On the AI side, we are really staying away from a lot of the credit and securitized bonds that are tied to data centers that are really reliant on the software as a service, right? So the SaaS bonds, bank loans are very heavily overweighted in that sector. So we are cautious there. Private credit, we own a few percent of the BDCs at the company level, but I do think that as I'm talking
on the equity
side, on the bond side, but as I'm talking to investors this week, they are starting to come to the realization that perhaps what they believed they were getting is not actually what's coming to roost.
What do those conversations look like? Because that is something that we're all grappling right now. Were you promised something different than you actually are holding? So what are they realizing?
I think they're realizing that maybe the illiquidity premium that they were getting extra yield for maybe isn't worth it, especially as we're entering this very volatile portion of the equity market as it's coming to realization about what the real impact of AI is going to be. So when you can get high quality liquid corporate credit at 5.5%, is it really worth taking on a little bit extra risk to get maybe high single digits?
That seems like it would be a problem for all of the private capital giants who have decided that this is the next leg of growth. It's going to come from retail and from high net worth because they want something that has an illiquidity premium. Does this really change the business model? Is maybe private capital, private credit specifically, not as well suited for a more retail high net worth audience?
I think that's what they're grappling with. I mean, yesterday I was talking to a lot of advisors who work with retirement plans. And, there's a whole discussion about whether crypto and private credit belongs in everyday Americans' 401k plans. And, actually, if I think about it, it probably does make more sense there because it's a long-term investment horizon. I think there is some value in diversification in having these alternative assets, but for the everyday investor who's counting on getting income and access to their capital, we think liquid markets offer a better opportunity.
Let's pull up the IG spreads chart, and I've been asking guests a lot over the past month why we haven't seen spreads blow out further. This is not the IG spreads chart. This is
tech.
This is 9355. There was an IG spreads chart that Dan Curtis put out this morning that showed like a little bit of a climb there. And then I was going to show you that chart because tech spreads have blown out.
Right.
What do you make of that? I mean, why haven't other spreads gotten wider? And this is also not it. And also, what do you make of the tech spreads?
For sure. I mean, at American Century, we were underweight tech going into this year, not because we anticipated there was going to be this AI reckoning, but spreads were extremely tight in tech because they're very high quality names. So we were underweight tech. We are being very selective at where we invest there. But on the other side, we haven't seen a huge spread widening across all sectors. And this is really what we thought was going to happen this year. We thought there would be these little periods where spreads widen a little bit. But that's why you have to be active. You have to be ready to act when the opportunity presents itself because we don't see a catalyst for a huge market correction, spread widening, recession.
Here it is, Joyce, by the way. So this, Dan Curtis, every morning we have a producer out of London, I'll give you a little inside baseball, who is an amazing charts genius and an Olympic level rower. And he put this chart out, kind of answering my question, but it's not a big jump in spreads,
but
right?
usually just how the capital stack forms, you'd expect that credit to be the first place to see the stress. And it's been the opposite this time around, that when pockets of stress arrive, it's been in the equity market and not in the credit market. Why is that the case this time?
I think it's because equity market valuations are so tight and it's so AI heavy, right? Mag 7 affecting everything that's going on in the S&P. So I think that's why you're seeing it there. Everyone's already very cautious due to how expensive some of these stocks may look. So I think the growth expectations and the outlook is much more important for equities. On the credit side, we do still hold some tech selectively, but those are through diversified businesses. We don't think Alphabet is going out of business. We don't think Meta is going out of business. Right?
Could you, though, have a repeat of 2015 with what happened with energy? Energy gets stressed in the credit markets and it spills out wider. Could that happen with software this time?
It could. But again, we would see that as more of a buying opportunity because we don't see a widespread economic slowdown or catalyst for a recession.
Are you trying to catch any falling knives right now? Are you out there like, these techs have fallen 50%, I'm going to pick some up?
Maybe my personal account.
Joyce, great having you with us. Thanks so much for joining us. American Century Investments Senior Client Portfolio Manager, Joyce Huang. Let's get a look at what's going on in markets right now because we do have big drops on the S&P. Actually, not quite as much as we saw earlier. We were down about 1%, now 2/3, 68.64. The NASDAQ down less than half now at 24,924. And you can see the 10-year yield continues to hold under 4% at 3.9754%. So Scott Bessent has to be happy about that.
Yeah, I guess. Yeah, that's at least one thing to be happy about, but probably Pam Bondi isn't happy about where the Dow is at the moment.
She wanted Dow 50,000. $50,000.
Drifting further and further away from that. By the way, UBS strategists just downgrading U.S. equities to neutral. They were overweight. Some of the single name stocks that we're looking at this morning, Matt. CoreWeave, a big loss, reporting a bigger than expected drop, and they did also boost CapEx shares getting hit 16.3%.
Dell says it'll generate about $50 billion in AI server revenue this year as demand picks up, and investors are rewarding them. The stock up almost 20%.
Not getting rewarded this morning. Duolingo plunging as the CEO says its drive to gain subscribers would mean slower earnings growth and narrow profit. And a producer, I'm not joking, has written in here that Danny uses Duolingo. I do.
What's your streak right now?
50.
50 days.
And I have a 23 score on Spanish, which I think means like I can say very simple things, but I would not survive if you plopped me in a tiny little Spanish village.
23, that's a F minus.
Yeah, correct.
Right?
It's not great. I'm working on improving it.
I'm going to try it as well. Coming up, cracks in private credit continue to show. Apollo cuts payouts. A KKR-linked fund slashes its dividend deeper. Are bigger losses coming? Ted Koenig of Monroe Capital joins us next. This is Open Interest.
Now to high interest, a look at what's making headlines around the world. An Apollo-managed credit fund is cutting its dividend and writing down assets after loan troubles. Midcap Financial slashed its quarterly payout to 31 cents and marked its portfolio down 3%, citing older investments. The firm posted $29 million in unrealized losses and shifted focus to a $100 million stock buyback. Meanwhile, a private credit fund managed by Futured Standard and KKR is falling after it cut its dividend more than forecast. The fund now plans to pay investors 48 cents a share instead of 70 cents. Profits are falling as interest rates drop and more loans go bad. About $440 million in investments aren't paying interest, dragging results down even further. And then, you can kind of get the theme here, a BlackRock private debt fund is under pressure after it slashed its dividend from 25 to 17 cents a share. TCP Capital is falling as declining rates and losses on troubled loans weigh on results. The firm says fixing challenged credit is now its top priority. And let's take a closer look at those cracks in private credit with Ted Koenig, Monroe Capital Chairman and CEO. Monroe has $23.6 billion in assets under management. Ted, thank you so much for joining. It feels like every BDC that's reporting, they're talking about marking down assets and marking down dividends. What's going on?
Hey, Danny. Good. Thanks. Welcome. It's good to see you again. You know, it's an interesting market. We lost about 150 basis points in yield because of Fed rate cuts over the last 12 to 18 months. So when you look at BDCs and you look at credit funds, what they do is they're basically a relative provider of return. So if the underlying rates go down by 150 basis points, it's natural that BDC returns are going to go down by the same amount. They're still roughly around 9%. So on a relative basis, if you look at the returns coming out of private credit and BDCs, you're still getting a 5 to 550 basis point spread over treasuries or government securities, which has always been the case. It's just we're seeing a compression in the yield curve, that's all.
And you and John Gray and others have talked about this, Ted. I guess the concern I'm worried about is whether investors realize that, or if they think that they were sold a product that outperforms more. And by the way, for these retail funds, a product that has more liquidity than actually exists.
Yeah, that's the key point, Danny, is that investors have gotten spoiled. You know, we've returned in our industry over 10% on a current basis for probably the last 20 years. I mean, Monroe we started our business 25 years ago, and we've delivered over a 10% return every year. So I think investors have gotten spoiled. The big change today is that we've got all the retail fund investors. Institutional investors are holding steady. They're not going anywhere. They're increasing allocations. We've seen allocations go from 10 to 20 to 30% to private credit with institutional investors. The big change in the last several years, the reason why you see so much volatility today is the retail investors got in and they were sold basically that they're going to get a 10% or better return no matter what. And then when the market changes and yields compress, it's natural that the returns are going to come down. So what you're seeing is kind of a herd mentality getting in, and I'm concerned you're going to see a herd mentality, trying to get out. And that's what happened with a couple of the big exits this week that you guys have talked about so much.
I mean, Ted, on your first point, I have heard from investors. In fact, yesterday I spoke with Marcy Frost, who runs CalPERS, and she said, yeah, we're sticking with it. We're even upping our allocation. We're overweight this stuff. But I wonder what happens if you see a herd mentality of investors trying to get out, especially considering the fact that they have, there are rules here. They have gates they can close. There have been agreements made. What will happen?
That's exactly, Matt, the issue. When you get retail investors that get in these funds that were sold as liquid funds where they can get out every quarter, every month, and investors rush and try and get out as a group, managers put up gates. You saw that happen last week. You saw it happen about a year ago with BCRED. And investors aren't happy about that because they feel that wasn't the deal that they were sold. The biggest risk I'm concerned about, and nobody's really talking about this, is the administration is pushing now trillions and trillions of dollars of 401k plans and other retirement accounts that are relatively unsophisticated investors getting into these private assets. I don't think they understand the deal. Institutional investors get it. Institutional investors today are taking advantage of the dislocation and increasing their holdings in private credit. I was in the Middle East a few weeks ago. I was in Asia before that. And investors need that 9-10%, 8-9-10% return to cover insurance obligations, to cover pension obligations. Private investors, individual retail investors, they don't understand the nature of the asset class, that it's really an illiquid asset class. It's not liquid. And the challenge that you've seen over the last couple of weeks is a lot of these investors believe they were getting into a liquid asset class when they bought into private credit.
It feels like the worst time then, Ted, because it's not just the administration making a push into 401ks. It's a lot of your peers that are making huge pushes into retail because they feel like they need it in order to keep growing and in order to survive. Ted, are we going to look back at this experiment and say it was a mistake? Maybe not directionally, but in the scale that firms are trying to achieve.
The challenge is a lot of the big asset management firms that you guys have covered are driven by growth, and they're driven by public market growth and multiples. And the challenge is institutional market. this is a mature asset class today on the institutional market. It's a $2 trillion business. Where it's not mature is in the high net worth, the wealth channel. That's growing at over 100% a year. So it's natural that the very large asset managers are going to want to grab as much assets as they can when they can. And this has been the convenient place to do it. I mean, years ago, we were talking about private equity as the big asset growth engine. If you look at the big players, the Wall Street players, I mean, KKR, Apollo, Carlyle, Ares, these are all credit managers today that historically were private equity managers. So we've just seen a tremendous amount of growth in the industry, and the growth in the last few years has been coming through the retail channel. And that's what's driving a lot of this volatility. It's not the institutional side. So I think that the challenge is going to be to control either the retail inflows or to make sure that we're putting the retail investors together with the institutional investors in the same funds,
hey,
not
Ted,
create separate retail.
I apologize for jumping in. We're just running out of time, and I do want to get this in about consequences of that if we don't get that, if we don't get to that responsible type growth. Does it get systemic, the risks, if we head down the path that we're currently heading down?
Well, what it does is it requires investors to invest those assets that are coming in. That's the bigger risk, Danny, that you're focusing on. Not the credit. It's forcing investors to invest in deals and put assets on the books that they may not otherwise put on. That's why being selective and being able to manage the growth is so crucial in this industry.
Ted, this is such an important conversation. Thank you for joining us, Ted Koenig of Monroe Capital. And we're going to have more on the private credit markets from Bloomberg Invest. Matt and I will both be there. Open interest will take place live Tuesday and Wednesday from the Invest conference. You're going to hear from Apollo's Mark Rowan. Yours truly will be speaking to Michael Arrighetti of Ares. Don Fitzpatrick of Soros Funds will also be there.
And Bruce Richards. I'm excited. You know, the first time I heard someone warn about software.
Yeah, it was Bruce.
Because of AI was a couple years ago now, Bruce Richards. Up next, how the Paramount-Warner deal will face regulatory hurdles. This is Open Interest. As investors cheer the Paramount win for Warner Brothers, the road to regulatory approval is just beginning. The Senate Judiciary Committee has scheduled a hearing for March 4th to examine the Warner Brothers sale. Here to discuss the deal is Bloomberg Deals reporter Michelle Davis. Great to have you on our show. I know you go on Danny's Wednesday show now every week. Shouldn't this be a slam dunk? I mean, the Ellisons kind of have the GOP on their side, right?
Yeah, but
they're big donors.
It's true, but they're not fully out of the park yet. I mean, this is really something where they're still going to have to win in the court of public opinion, and with, state AGs. We have Elizabeth Warren coming out yesterday saying this is going to be a horrible deal. It is still a merger of
She said that about Netflix, too.
It's true. And it is still a merger of two studios. So, that's going to mean job losses. It's not a guarantee that they will get approval. But, of course, it looks like they at least were ahead of Netflix on that front. And I think what's most surprising about how this all panned out is just how quickly,
Well, why did
won.
Netflix back off so quickly on this?
I mean, there's lots of speculation.
After Ted Sarandos met with the president.
The official line is that it was, Netflix has always been a company that adhered to financial discipline. Obviously, their stock has plummeted a ton on this deal. And at some point, the additional value that they would have had to provide in terms of an offer price to even beat or match Paramount was just going to be too much.
And now they can make a few movies with that $2.8 billion breakup fee. Michelle, thank you so much for joining us. Bloomberg's Michelle Davis, who, by the way, is a scoop machine. She joins me every Wednesday at noon on Bloomberg Deals. So tune into the next one to see what stories Michelle will bring us. Coming up, meet the CEO of Algorhythm, the little-known karaoke company become AI company rattling the trucking industry. The disruptive potential of AI has rattled markets for weeks in what some have been calling an AI scare trade. Among the companies hit hardest were trucking and logistics stocks, which tanked after Algorhythm, a former karaoke company, said that its AI logistics platform is helping to make trucking more efficient. Joining us now is Gary Atkinson, the CEO of Algorhythm, which, Gary, can I just say Algorhythm is literally my favorite company name that's ever been created, because rhythm, spelled like rhythm. That's totally besides the point. How difficult or how easy was it to convert your company? What was the structure in doing this, from being a karaoke company to one that could disrupt an entire industry?
Good morning, Danny. Thank you for having me on today. Excited to be here. So the transition from karaoke to AI logistics obviously wasn't easy. It required a few years of planning, in which we identified an exciting new category that the market really hadn't seen yet. I mean, back in 2 years ago, nobody was really talking about freight as an orchestrated network. Nobody was talking about AI and the impact on logistics. And so we just saw a tremendous opportunity to get into the space and be one of the first movers and make that pivot out of consumer product and into logistics.
So how do you do it? I mean, how do you take cost out of that?
Yeah, great question. So look, if you think about the traditional freight brokerage model right now, that same model has been in existence for close to 100 years with very little change. And the way that the traditional brokerage model works is they think about freight as a series of one-off transactions. And why is that a problem? Well, look, today, roughly 1 out of every 3 miles that a truck drives globally is being driven empty. And by our estimation, that equates to over $1 trillion a year of waste and inefficiency in the space. So what are we doing? What are we doing differently? And that's really what all of the media attention has been about over the last few weeks. And what we're doing is we're completely thinking about freight from a totally different paradigm. We're not looking at individual transactions. We're not looking at how do you get a load from point A to point B. What we're doing is we're thinking about an orchestrated network. And what does that orchestrated network mean? We're looking at flows. We're looking at how does a truck go from point A to point B to point C and then back to A again? We're thinking about, and really the heart of the product is our AI predictive and optimization engine that is planning not just days in advance, but literally weeks in advance, predicting loads before they even exist and planning them out in real time so that these trucks can continue to stay as fully utilized as possible.
Gary, is there anywhere else you can use this technology, or are there any other sectors or industries that you're also looking at disrupting?
Well, I mean, certainly for now, look, there's a ton of blue sky when it comes to the truckload transportation space. It's the backbone of the global economy. It's a $3 trillion a year industry. And so there's plenty of room for us to operate there. And I think the benefit of our orchestrated platform really serves the trucking industry the best because it's a dynamic network, right? It's different than ocean, different than air, different than rail. Those modes are much more structured in the way that they move goods. Whereas transportation with trucks, they're constantly moving all over the country. And that's really where our platform excels the most.
I wonder, I mean, it's quite a pivot, obviously, from karaoke to trucking, but have you thought about other things, other businesses, Gary, that you could be disrupting? I mean, could you make another pivot?
No, I think right now, look, we found, when we built this platform back in 2018, nobody was thinking about this. Nobody was thinking about AI and the impacts on freight or looking at freight as a network. And so we see just a tremendous amount of blue sky in the space to continue to grow. If we do look at acquisitions, it will be within this category to complement and expand upon the semi-cap platform.
What did you make of the reaction in markets to sell off C.H. Robinson 15%, Landstar Systems 16%? Did you look at that and maybe be surprised, but say, yeah, that makes sense. That's just how disruptive we are?
Well, look, I think that, were we surprised? Yes. But at the same time, this was a conviction and a vision that we've had for a very long time, right? Anytime you see an industry where roughly 33% is just completely wasted in the sense of empty miles and inefficiency, there's a lot of room for improvement. And I think what I've seen, particularly over the last few weeks, that's been the most exciting is that the conversations are starting to change. If you had asked somebody a year ago, everybody was saying, well, this idea of an orchestrated network, it's just too theoretical, right? Let's see it work in practice. Now, over the last 2 weeks, we've had some of the largest logistics service providers, carriers, bankers, analysts, all reaching out to us, inquiring as to how does this model work? How is this model going to disrupt the status quo? And I think what I've been most surprised about is just the open collaboration that we've been seeing from the industry in general.
Well, I mean, this is the promise, right, of AI. This is the good side of the coin. You can reduce friction, bring down prices, and the end consumer can save money. Society benefits. It's a very serious story, but I have to ask the unserious question about your favorite karaoke song, Gary, because you must have one.
I get that question actually a lot. So my favorite karaoke is Don't Stop Believing, just because.
Classic.
It's a classic, and also when you believe in yourself and you have conviction, good things tend to happen, and we've seen that play out here over the last few weeks, so I just have to go with that.
I thought he would say truckin'.
That would be a good one, too.
Gary, great to get some time with you. Hope you can join us at some point in the studio. Gary Atkinson there, the CEO of Algorhythm, making AI work the way it's supposed to. Let's get a check on the markets right now. We are down just about 0.2% on the S&P 500, 68.62. The level there brings us to a loss for February. And we could be looking at a loss now year to date. We're right at the unchanged level. The NASDAQ down about 0.5% at 29,919. And the 10-year yield holding under 4%. I think probably the most important headline of the market check.
I would say so. Is that AI labor fears coming home to roost? Some of the individual stocks also based on that. Is this weighing on the 10-year yield? Block shares up 19%, cutting nearly half of its workforce. A bet that AI can do more jobs and do them more productively. CEO Jack Dorsey says many companies will ultimately need to cut staff due to AI. And, maybe this is a good example. Your shareholders reward you if you do that.
As a result of those concerns around AI disruption, those shares of big banks and asset managers are tumbling. We're seeing, I think, card issuers falling as well. So a lot of the concerns that James Van Galen voiced in his Trini research note on Sunday night playing out on this Friday. Also, Apollo lowered its quarterly payout and wrote down its portfolio by about 3%, citing weakness in a handful of older investments. As a result, Apollo stock is down 6.5%.
By the way, it's kind of remarkable that now credit card companies have been tied to the AI trade because of James's fantastic piece. That now every time there's an AI scare and we're worried about white-collar jobs, credit card companies are falling.
Well, but it's the exact same reason that Algorhythm is able to take costs out of logistics, a reduction there in friction. Coming up, open to talk. Speaking of friction, the Pentagon responds to Anthropic after rejecting its offer ahead of today's deadline. We'll discuss that next. A threat to society. This is Bloomberg Open Interest.
I offered more talks, so long as they're in good faith. We're always open to talks, and we set a deadline, and we met the deadline. And up until that deadline, I'm open to more talks, and I told them so.
That was Emil Michael, U.S. Undersecretary of Defense for Research and Engineering, speaking on Bloomberg Surveillance about the negotiations between the Pentagon and Anthropic. And to me, encouraging, because the Trini research note kind of freaked out markets, but far scarier than 10% unemployment is the government using AI as a potentially potent tool to track its own citizens. And even worse than that, probably, is allowing AI to autonomously control weapon systems. Does the government actually want to do those things? Bloomberg opinion columnist Dave Lee joins us now. Dave, Anthropic says these are red lines that they're not willing to cross, and hopefully nobody is willing to cross those lines.
Well, they've had a big boost in that regard, because just this morning, Sam Altman, the CEO of OpenAI, of course, he said he has the same red lines as well. And that's really useful for Anthropic, because it was a pretty lonely battle for much of this week. And if the Department of Defense is looking to say, well, we're going to stop using Anthropic, the natural alternative would be OpenAI. OpenAI saying, we don't want to do that either. So now I think the momentum, the power is actually with the AI companies in this negotiation.
Well, except for the fact that you've still got Grok, right? And Elon Musk doesn't seem to have any red lines.
No, but he does have an AI that's not quite as good as OpenAI and Anthropic's, and I think that's kind of crucial to this discussion here. It's, at the moment, Anthropic's Claude is the only AI system that's permitted on classified networks at the Pentagon. And changing that AI isn't just a case of saying, well, load in the new one, right? This is recoding a lot of things. This is a complicated process, and Grok fundamentally doesn't seem, from what people have been telling me involved in these things, isn't up to the job quite as well. There's a reason why Anthropic got that contract in the first place, put it that way.
Dave, the thing that makes me feel somewhat uncomfortable in all of this is that we're just relying on the ethics of corporations to not go there, that the government isn't putting up guardrails, that this thing is growing so quickly, and we're just hoping maybe by sheer goodwill, Sam Altman and the rest of them won't step into this dark world where AI might take us. Is that the only guardrail at this moment?
Isn't it an interesting twist that the companies are the ones reining in on this?
True.
I think
because the other side is, do you rely on the ethics of Stephen Miller, Pete Hegseth, and Donald Trump?
Precisely. Now, where I think we can take some comfort, I guess, is that the very best AI researchers seem to be of a similar kind, where they don't want this to be done for bad reasons. It's a passion they've had in their work for doing this for the benefit of things, as opposed to being a danger. Now, Anthropic, way back when it was founded by a bunch of people who thought OpenAI was abandoning its principles, right? So they went to create a company that was more focused on safety and things like that. Whether people believe them is another thing. However, if Anthropic was to go against that with this sort of arrangement, the risk for Dario Amodei, the CEO of Anthropic, is that a lot of his talent might say, well, hold on, I didn't sign up to this. So he faces a real problem. He's kind of caught in a bit of a lose-lose situation. Either he annoys the Pentagon or he loses the backing of his own employees. Seems like he's putting preference on keeping his employees happy.
Is this all just a dystopian, sci-fi exercise?
Feels like it, right?
When you read the Citrini research note, did you think that's going a little too far? I mean, I keep saying that the next day, the CEO of Workday came out and said, hey, guys, Anthropic still uses our software. OpenAI uses our software. If anybody is going to get their lunch eaten, it should be us.
I think, and I've written about this before, a lot of this stuff that we're seeing, some of these commentaries, it's kind of like fan fiction for AI, right? People are saying, oh, this is what the end result's going to be. The truth is, nobody knows. I think the idea that AI is simply going to wipe out a lot of software stocks, I think is overblown. What AI seems to be good at is the easy part of those businesses, creating nice interfaces and systems. What it's not good at is the hard part of those businesses, legal things, auditing, and just general sort of, customer support, all these things. I think the people on the AI side that are saying, don't get too carried away, among them Jensen Huang from NVIDIA saying it was absurd that this would be the case. I think so caution is probably the wise thing here.
After DeepSeek, the discussion around Jevons paradox came up a lot. This idea that you get advances, things are more efficient, so you use more of it, and you actually have more people, or in that case, energy usage actually goes up. Can we say the same for the use of AI? That maybe you can code more software because of it. Indeed has seen software engineering posts list up 11% year over year. If all of a sudden software is easier to write and easier to make, don't you need more humans who are overseeing that, feeding the code in? Couldn't Jevons paradox apply in this too?
I mean, possibly. That I guess that with Jevons paradox, it's kind of the cheaper it gets, the more you can do, the more opportunities that come out. That surely feels true with AI. I mean, if you're a company right now, like Workday is a good example, the fear is that every company might say, well, rather than go to this expensive firm that does all our HR stuff, we'll just get a couple of people in our company to build it themselves. That may be possible, but I think it's quite striking that the people who are doing the best work with vibe coding, as we call it, are already software engineers, right? They already have that expertise. They're already putting it. So
it's not Matt and me vibe coding.
It is Joe Weisenthal.
Yeah, true. But
I've been trying and failing quite spectacularly, so I don't know what that says about the whole affair.
What did you think of the whole block thing of using AI as an excuse to axe 40% of their employees?
I've seen Jack Dorsey at various points kind of get overexcited about the potential of a new technology. I wonder if that might be happening here. It seems like an awful lot of a business to an awful lot of our workforce, almost half, I believe it was, to get rid of, essentially, on the basis that AI is coming. So I guess we'll see.
So, by the way, I want to ask, I'm going to reach out to Eric Brynjolfsson and Andrew McAfee, who wrote a great book about this, Race Against the Machines. But in the Citrini piece, he seems to assume that there will be no new jobs created from this technological revolution. And every single one we've had in the past, be it the printing press or the telephone or the internet, has resulted in a whole new industry or industries cropping up. What's your take on that? I mean, even if, people lose jobs at Block, which who knows what Block does, but do they get jobs doing something else that we don't know about?
Well, I think when we draw these comparisons back to previous revolutions, you kind of go, well, look, these things, like you said, they created jobs. Firstly, it didn't happen immediately. It took a long time, and AI is, crunching that amount of time into what feels like months sometimes. Also, another thing I think is very important is that a lot of the things that made those new opportunities possible wasn't just the technology, but it was also good policy around the technology, policy that helped with the transition, helped with reskilling, or helped with investment in, say, public works that use the new technology. That is something I think is still missing from AI. The policy questions around how the technology should be used and regulated are getting completely bogged down in Congress. And when the states try and do their own, they get criticized by the White House. And it all gets very complicated, and the companies worry they're going to have to deal with 50 different laws for their AI. I think if we're going to have a situation where this is going to be a job creator, the development of the technology needs to go hand in hand with that policy making as well. And that's certainly a missing piece from this so far.
Dave, great to get your take on this, and loved your piece. Dave Lee writes for Bloomberg Opinion. You can check out his work. If you're on the terminal, type OPIN GO. On the internet, you can probably type bloomberg.com/opinion, I'm guessing.
That's correct.
That's right. Okay. So, but really, really highly recommended. On the mobile app, you can even, under news, you can hit opinion, which is great. Coming up, if you have weekend plans, well, we want to add something to that. You're probably already planning to watch the premier race of MotoGP in Buriram, as am I. Sprint tomorrow, race on Sunday. But also on both days, 7 to 10 a.m., you can watch our new weekend show, and we're going to give you a preview next with David Gura and Christina Ruffini. This is Bloomberg.
Now a look at what's ahead for markets. Over the weekend, Berkshire Hathaway releases its 2025 annual report, including new CEO Greg Abel's first annual letter to shareholders. On Monday, we're going to get ISM manufacturing data. Tuesday, more retail results roll in, Target leading the way. Wednesday, the Fed's beige book plus earnings from Broadcom. And Friday brings the U.S. jobs report, Matt.
Do we do the trading diary on the show?
Yeah, we do.
Do we do that every Friday? I haven't noticed doing that.
You've done this show longer than I have, so that worries me.
One thing I'm going to be doing now every Saturday morning is watching Bloomberg This Weekend. It's hosted by my good friend David Gura, our new hire Christina Ruffini, which I'm very excited about, and Lisa Mateo, who is the pro from Tom Keen's Bloomberg Surveillance. David and Christina join us now on set, and I'm pumped. When I first saw the promo, the commercials running for your program, I was like, I am definitely going to get up.
We got to live up to that. It's a hard challenge.
Our promo team did such a good job that our marching orders now are to make the show worthy of the promo, which we think it is. We think it's worth it.
Well, I mean, that's why we hired you, because you can do that,
No
Christina.
pressure.
Your
No
good
pressure
friend David
whatsoever.
Gura and that other woman who's on set. But I'm here.
Talk to us about what we're going to see here, because it's not going to be your typical Bloomberg during the week show, right? It's still a weekend, so you've got to.
So here's the thing. Can I tell you?
Yeah.
You ready? We've got couches.
There are couches.
Oh, wow. Soft seating.
There is
Soft seating, as we say in the business.
But look, we're also doing hard news, and there's a lot popping off this weekend. You guys mentioned Berkshire Hathaway. That'll be coming out on Saturday. We've got a full court press ready to cover that. There's also, we don't know what's happening with Iran. We'll be ready to keep everybody up to date on that. And
I was told there'd be no earnings on the weekend, and lo and behold, we have Berkshire Hathaway earnings tomorrow. So we'll cover that. Greg Abel's letter when it comes out as well. And then, as you know, like a lot of stuff is happening on the weekend. So a lot of best laid plans are best laid. We'll see what happens over the course of the weekend as well, but we're poised to cover live events as they happen.
Well, and Christina, you have a lot of experience covering the White House, covering Washington, and I mean, we could have news out of Iran any day now. It's good to have you as an expert on this.
I think that's very possible. I have been calling some folks today. Look, they've done that authorized departure out of the Israeli embassy, the U.S. Embassy in Israel. And that's a bit of a sign that something could be happening, right? That's not an evacuation, but that's saying if you're not essential, if you want your kids and family to leave, you should do that now. So we are ready and keeping tabs on everything
and
that's
we've
happening.
got Hakeem Jeffries, the minority leader, on the show as well. A big question for him is, yes, there's going to be this vote in the coming week on war powers resolution. How does his caucus feel? Yes, about the prospects of there being war in Iran, and more so, sort of what does that accountability mean in this day and age where the president doesn't seem to care that much if, in fact, the Congress goes along with him or not?
I'd say part of the reason I'm so excited for this show is that day to day, the markets feel like they're losing their minds, and it's really easy to get distracted by that. But I feel like this is an opportunity to also take a step back and talk about these big picture things. So Hakeem Jeffries is one of the guests. Who else is going to be joining?
Well, on markets, we've wrestled Tom Keenan and
of course.
A few other of our colleagues who cover markets. And of course, the Anthropic story is Royal and Katrina Manson's going to come on. So you're right. It's going to give us an opportunity, I think, to exhale a bit on the weekend so much as we can and spend more time on these investigations and deeper dives that during the course of the week, as you well know, are often hard to dig into deeply because just the thrum of the markets makes that difficult.
And that's something we want to do on Saturdays. We're also on Saturdays, we're dedicating a chunk of time each week to what we're calling C-Suite Saturdays, where we're going to have a CEO come in and talk to them not just about the usual things I talk about on Bloomberg, but, you know, strategy, family life, look aheads, leadership style, all the things, you know, kind of really get into their heads of these CEOs and Fortune 500 company runners and see where they got to, where they are, and where they're going.
They'll be on the aforementioned couch.
I'm very much looking forward to the show. David Gurr and Christina Ruffini will be hosting Bloomberg This Weekend starting at 7 a.m.